Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling? And for those of you interested in subscribing to Chen, now's the time to do it. Of the first few days of this quarter, Chen is accepting new subscribers up to a certain limit, and there still is room. So if you're interested in subscribing to Chen, now is the time to do it. Go to miningstocks.com to sign up for Chen's letter or my letter as well. I do want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. I also would like to encourage you to keep your questions and comments coming to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com. And my Twitter handle is JTaylorMedia. Also, like to thank our sponsors for making this show economically viable. Our sponsors for today's show are Carlisle Goldfields, Copperbank Resources, Colinex Mines, and we want to welcome our new sponsor today, Oren Resources. And we'll be talking to the CEOs of all of those companies along the way over the next few weeks. Today's show I've titled The Powers Behind the Throne That Own and Control America. And James Perloff, Jeff Deist, and Michael Oliver return today. I'll be talking to Michael in just a couple of minutes from now. Perloff returns for his monthly visit to discuss his latest book titled Truth is a Lonely Warrior. Last month we discussed chapters 1 and 2 of his book, and then he told us why he believes that America has, that the policymakers have had to use false flags to get the American people interested in waging war over the past 6 wars, the last one being the Iraqi War. Today, James will cover material in chapters 3 and 4 of his book. And those chapters will cover the topics of who really owns and runs America and how they have come to gain control over our country, even as the population has been convinced that they are the owners of the country. Of course, that's what the Founding Fathers suggested. We had a republic, not a democracy, but a republic in which we had representative government. People, it was supposed to be a government by and for the people. Well, do we still have that? According to James Perloff, not so much so. So we're going to be talking to him about that today. Jeff Deist, he's the president of the Mises Institute, will be with me at about 3:15. He'll be talking about an upcoming event at the Mises Institute that will be held in Connecticut that I plan to attend, and hope to talk to Jeff about that. Some very interesting speakers at that event. James Grant, Judge Napolitano, David Stockman, Peter Schiff, Joseph Salerno, and others will be there. And also want to talk to Jeff a little bit today about perhaps get his comments on Rand Paul's announcement. Jeff being the former headed up and worked with Ron Paul so closely. He was the chief of staff for Ron Paul. He definitely, I'm sure, will have some comments about Rand Paul, Ron's son, and as he just announced, I believe it was yesterday, that he will be running for president. But at the same time, we're talking about history with James Perloff. We're talking about current events with and economic policy and theories with Jeff Deist. We also like to check in with Michael Oliver, who helps us understand what's happening here and now in the market. So welcome, Michael. Glad you could join me again today.
I'm glad to be back.
Always good to have you, and I want to just tell my listeners the website to go to learn more about Michael's work is olivermsa.com, olivermarysamalbert.com, olivermsa. Michael, the stock market, again, seems to be humming right along. I see the equity market is up now. The Dow is up 76. The S&P is up 4.6. NASDAQ is up 15 or so. Not great moves, but pretty solid moves, it would seem. And, for one, I've been on the bearish side of this market all too long. It's not been kind to me because I've not believed in it. And yet it seems as though the market keeps surprising to the upside. What are your thoughts now on the markets, looking at your momentum and trend analysis?
Well, the long-term metrics that I measure, that MSA measures, momentum structural aspects of the market, basically began to break down in October with that October break, and again in January, such that my long-term indicators now say top. Now, that's not necessarily actionable because within trends, there are lesser trends. And the lesser trends of the intermediate action of the S&P, the type of trends that last 3 or 4 or 5 months, they're positive. Now, I have to call them mildly positive or neutral even, because consider the following. Well, the S&P is up on the year 1.2% right now. It's month 4 of the new year. Gold, in contrast, is up 2.2%. Nobody's beating that drum, I don't think.
No.
The gold bulls are worried and the stock bulls are exuberant, and yet gold's up more than stocks. And the S&P, when you break it down within its larger sectors or its key sectors, and using the pure ETFs that have only financial stocks or only tech stocks and so forth, the tech sector measured by the Morgan Stanley Tech Index, purely technology, traded down on the year today. Earlier in the day, you were down on the year. It's month 4 now. Financials are down on the year, have not been up on the year. Industrials are down on the year, not been up on the year. I'm talking the industrial sector, not the Dow Industrials. Transports, despite the positive benefit of low energy, are down 5% on the year. So when one is impressed by the up market, break it down and take a look at it. And it isn't so impressive as it seems. And I still regard it as a topping process. So I'm focused on the intermediate breakdown levels. I think those start at 2050 and extend to about 2030 on the S&P. If we go through those levels, we're going down. And right now they're just dancing on top of them. So I don't think they can dance on top of them too much longer.
Well, you had a very interesting term that you used in your last missive, the weekend missive. You talked about bullish hyperventilation. What do you mean by that?
Well, when a market does not exhale, and consider up as inhale, and exhale as a correction. A lot of my metrics have not exhibited exhaling behavior in very many months, such as oscillations below things like 3-month averages or 10-month averages, where you get an exhale, but it won't even go below some modest average. I'm not talking about annual things, but things are much shorter term. So it indicates a willingness on the part of the bulls to buy dips and not even wait for good breaks. That's so eager. It indicates exuberance. Even if the market's not going ballistic, on the downside, it won't even correct what you could call a good correction. So therefore, I ascribe the attribute of exuberance or inhale only. And hyperventilation, therefore.
Well, I mean, that doesn't work too well if we don't exhale once in a while. I guess the same thing is true of the markets. Ultimately, you can't inhale forever is the message, right?
You turn blue in the face. That's right.
Yeah. Well, switching to gold and the dollar, I noticed the dollar is up very strongly again today. It's up over a point on the index. You just mentioned, though, in spite of that, the dollar has been strong. It's got up to parity, up to unity, I guess, is over 1 on the index. And yet you just mentioned a moment ago that gold is up 2.2%. Normally, you've made the point on this show, of course, that you don't have to see the two running in opposite directions, gold and the dollar. But clearly both of them have been on the upside to an extent this year so far. What are you seeing now for the dollar and for gold?
Well, for gold, I'm very pleased with what happened this week after last Friday occurred Monday in the futures market. The market traded up above its three-quarter average. Now, it's not because it's an average that you got above that makes a big difference, but it happened structurally that is an important rally. It tells me, it indicates strongly to me that the secondary test we had of the November low was just above 1130. Last month we got down into the 1140s. And I know at that point in time, all the bears were just cheering, we're going to blast to new lows, go to 1100 or 800 or whatever they were fantasizing.
Sure.
I didn't see the case for that. I saw no necessity in that because the November low, by my measures, was righteous. I mean, and it was as pristine as you could get for a final low. And therefore, I thought that the March sell-off probably should hold. It did. Getting back above 1218, which is the three-quarter average this quarter, yesterday on gold, that's a good sign. It's not a breakout. It just says, I'm safe. It's like, when you were a kid playing a game and you touch the home base, okay, you're safe. Yep. I think that was a good step. As far as the dollar goes, I think it's entered a congestive period. It got over 100 on the dollar index, dropped back down into the 96s. I think you could see it below 95 in the next month or two. And I think the ups and downs you're seeing now are part of a congestion and a pullback process. In particular, what I would be focused on is not so much the dollar index having a pullback, but the yen.
You've turned somewhat bullish on the yen for now.
Well, it hasn't triggered my numbers, but I think it will. It's got the pregnant look of a bottom that's just going to break out, and the yen is not a heavily weighted component of the dollar index. It's less than the euro. It's like 57% of the dollar index. The yen is only like 13% or so. It's the second biggest component, but still it's small. So the yen could have an upside tantrum and really not cause the dollar to drop all that much. And the yen is a particularly potent, I called it the katana in the eye, the sword, in the eye of the Bank of Japan, because they've wanted it to go down. It has gone down. It's gone down severely over a long period of time, a couple of years. So they've gotten their wish fulfillment. But it looks technically poised now to poke them in the eye on the upside, which would upset their sense of control over the events, much like any central bank has that sense of control right now. Yen futures is what I look at. They're trading below 84 right now. You get above 86, I wouldn't be shocked to see the yen futures run up into the 95 to 100 area, which would upset a lot of ancillary situations. A lot of carry trades are occurring where they borrow the yen at effectively nothing, take the money and parlay it elsewhere.
Yes.
And I think if the yen rallied, it would upset a lot of apple carts.
Yeah, because all of a sudden people are going to have to pay back in more expensive yen than they thought they were going to pay back in. And that could really, I would think that would be potentially, I mean, not talking as a technical analyst because I'm not one, but it would seem to be bullish potentially for gold, something like that.
And I think inversely for the S&P, it has a very, very strong negative correlation to the S&P.
Sure. Yeah.
So I think.
I think you mentioned in your missive, in fact, that according to Bloomberg, that the carry trade, the yen carry trade now is as large as it was back in 2008.
I don't know what their metrics are, but I trust that they did their homework, and that's what they're alleging, which doesn't surprise me. It's just not surprised.
Well, it's all about making money in the short term, I guess, isn't it? It's about borrowing cheap and as cheap as possible, and then you sort of gamble, or you try to hedge your risks, I suppose, if you can, in the currency side, to the extent you're able to do that. But
that's what long-term capital management thought too.
Yeah, exactly. The interesting thing about derivatives is that derivatives, on a micro basis, seem to reduce your risks, but I think on a macro basis, potentially systemic basis, actually increase the risks. But you're really very interesting work that you're doing, Michael. Always appreciate it. We have 1 minute left here. I think my engineer is telling me. How does the long bond still look pretty strong?
I need to reassess it. I'm focused most on the 10-year notes in Japan, Germany, and here, and they have some vulnerability, but they're not close enough to the points of vulnerability. I am suspecting that sometime this year we're going to have an interest rate problem in the 10-year on-out maturities. In the safe markets, Germany, Japan, and here, where rates do in fact rise, and nothing to do with the Federal Reserve. The technicals were not close enough yet to trigger them, but they are there, they do exist, and I suspect before the year's over we're going to see those structures broken, in which case we will in fact have higher rates. Nothing to do with the Fed again. Yeah.
One can only imagine what kind of chaos and havoc that could wreak on our markets once we start having interest rate rises, and of course that's what the markets seem to be so scared of, and as soon as the markets start to throw a hissy fit, out runs a Federal Reserve official to assure the markets that, we're not going to do anything irrational, we'll keep the money flowing. So, but ultimately, Michael, I think it's going to break down, and we're looking to you for your insights and the charts to help us see when the markets are going to start to exhale or do what they should do if they were left alone in their own devices to do. So want to thank you very much for being with us again, and I look forward to talking to you next week, hopefully.
Glad to be here. Thank you, Jay.